Good afternoon, everyone, and welcome to our much anticipated mid-year valuation stats update webinar, where we will discuss the latest trends in pricing and cap rates, and really just how buyers and sellers are adapting their M&A strategies as a result of how quickly prices are moving. And it's an especially important conversation right now because of that. Really, in every corner of the senior care industry, we're seeing values rise for uh, pretty much all types of properties. So with these stats, we're happy to provide some additional clarity to the market, and our experts here on the panel are definitely going to lend a lot of clarity. So it's also kind of become an annual tradition that this mid-year stats update webinar is sponsored by Health Trust. They've done it the last several years, and very happy about that. Health Trust serves a variety of national clients in the industry, including the most notable lenders, operators, and developers. The firm operates from 4 locations in the US, in Boston, Denver, Los Angeles, and Sarasota. And Health Trust's CEO, Alan Plush, joins us on the panel today. In his more than 30-year career, he has specialized exclusively in healthcare and senior care valuation, with extensive experience in the appraisal of nursing homes, seniors housing, CCRCs, hospitals, and MOBs. He's also invested in the industry himself through several ventures and has developed an ALMC community in Sarasota. So he puts his money where his mouth is, too. Welcome, Alan.
Thank you.
Aaron Will joins us today from CBRE Capital Markets, where he helped launch the seniors housing debt practice. And he's been quite prolific ever since, as you can see in the many accolades here on this slide. Now he co-heads seniors housing at CB, including its investment sales, mortgage banking, and equity capital markets activity. And he has certainly been witness to how fast seniors housing values have been moving with some of the deals he's closed. So thanks for joining, Aaron.
Thanks, Ben.
Next, we have an active buyer in the space in Kelly Sheehy, who founded Arcole Partners in 2025 to focus on acquiring and operating value add and opportunistic seniors housing assets across the US in partnership with the investment firm Town Lane. Previously, Kelly was senior managing director and portfolio manager at Artemis Real Estate Partners, and he brings more than 20 years of healthcare investing experience, and he'll be putting all of that to work today. So welcome, Kelly.
Thanks, Ben.
And we have another very prolific guy from the capital markets and investment sales world in healthcare, and that's Ari Adlerstein, who has closed over $40 billion in transaction volume throughout his career. He also recently co-founded T7 Capital, a boutique healthcare advisory firm, and he's already hit the ground running with more than $5 billion closed in total debt, equity, and investment sales. That is a moving target. So Ari, correct me if that number is changed since then, but he's also no stranger to our webinars, and very happy to have his perspective on the panel today. Welcome, Ari.
Super excited to be here. Thanks, Ben.
Fantastic. And thank you all for agreeing to do this. It's certainly some effort goes into this, and it is definitely appreciated by me. Just a couple things before we begin. Listeners can enter any questions for the panel in the Q&A box within the Zoom window, and we'll do our best to get to them throughout the call. We only have an hour today and a lot of stats and topics to get to, so we'll try our best. The slides will be posted in the chat here shortly. And if you want to see more as far as statistics, actual deal comps, and lists of the active players in the industry today, then head to the URLs that you see here on the slides for more information on Levin Pro or the Senior Care Investor, or to book a demo for our whole platform. We also published our mid-year update to the Senior Care Acquisition Report this morning, so subscribers can download that from the platform, and please be sure to look out for that. Today, we'll be covering a lot of statistics and topics just in the hour today, and they were all compiled after an exhaustive effort to collect hundreds of prices, property financials, and other deal information on deals from the first half of 2026. So thank you all very much to everyone who helped us with that effort of data collection. Rest assured, to anyone who wants to help us in the future too, all that confidential information only goes to the averages that you'll see here in this webinar, but also in our reports. So any individual deal information is never compromised. And we only include closed arm's length sales involving both the property and the operations. No vacant properties, low-income housing, or any allocated properties from portfolios. And another note, our cap rate data is based on market cap rates on trailing financials, which is a topic of conversation in itself. We'll probably get to later. But I want to start off simply with market activity. We've seen in this chart here that deal activity is off the charts. And at this point in the year, we're probably at over $1,000, 1,000 deals for the trailing 12 months. Just totally unheard of in the space. And these are just the publicly announced deals, either to the market or to us with permission to release them. So the actual market is even more intense. And we're seeing larger deals than in previous years too. So Alan, I'm going to start with you. And then I want everyone else to kind of take this question. What corner of the market are you just busier in compared with last year? And if it's in every corner of the market, that's a valid answer too.
So we do work across the sector, and obviously most of it's for lenders. We also do work for pension funds and PE groups. Those numbers have stayed the same. The bank commercial bank sector has really spiked. I want to say that started maybe 9 months ago, maybe 12, and but it literally. We probably work for, in a given year, roundly 200 unique clients. In that sector, commercial lending, it was like a switch flipped. It wasn't just one, it was all of them at once.
Ari, what about you?
Yeah, I would say every corner of the market, we're super busy. And it's good to be me. It kind of feels like I'm a kid in a candy shop every day with deals. And that's a lot of fun, a lot of pressure. The debt market is on fire. And I was just on a call with a lender this morning who brought up this concept that was so foreign to me, which was, hey, we want 10% deposits. If we're going to write a $100 million loan, we want you to put up 10% deposits. And like, this was the bane of my existence for probably 2 to 3 years, certainly coming out of COVID, where a lot of banks were looking for deposits. And I frankly haven't even heard of it over the last like 9 to 12 months. And I'm like, really? You're still looking for that? That just demonstrates just how strong the debt market is today. And it's very active. And then same on senior housing and SNF sales. We've just been super busy all around and good times.
Aaron, would you agree?
Yeah, I would agree wholeheartedly. I would say with respect to the product type that's arguably the most active, the product du jour is full continuum, major markets, primary markets, or assisted living and memory care, and primary or secondary markets built in the last 10, 15 years. It's hard to satiate the demand at this juncture for that type of product. And we've seen really an emergence. One thing I wanted to point out of kind of core funds and core plus funds, some of them Odyssey open-ended core funds that couldn't spell alternative real estate, 3 years ago, that now senior housing kind of is at the top of the list. And that's a category, and same with the REITs that have several of them have core funds of their own outside of the REIT structure. So that type of capital chasing that type of deal has certainly been, very, very interesting to follow. And there's an unprecedented amount of activity in that segment of the market. Beyond that, I would say people are starting to chase yield in the current environment. And what I mean by I say that is, starting to look at secondary and even high quality tertiary markets and older product that stands the test of time just because of the cap rate compression in the Class A segment of the market. So we're seeing it all across the board. I would echo Ari's commentary with respect to the debt markets. More specifically, if you look at agency credit spreads, I've been chronicling them for 20 years. They're as tight as they've been over a 20-year time series, roughly 20 wide, 25 maybe of conventional apartments, which blew out to 150 plus basis points during the COVID era. And then the debt fund category as well, with warehouse lines and true debt funds that are not lending necessarily out of their equity capital markets, or excuse me, their equity funds, but rather asset agnostic and really like the yield premium in relation to apartments and certainly the operating fundamentals in relation to apartments. So those are some big shifts in the market as categories of investors and lenders that, quite frankly, we've never seen in my career.
Yeah. That's a great overview and a lot of topics that I and looking forward to getting deeper throughout the next 50 minutes too. So thanks for that overview. And Kelly, I know last year you were kind of just ramping up your acquisition activity, but what, if anything, is different this year compared to last year as far as the number of deals that you're evaluating, the types of deals you're evaluating, and then just what it's like to be a buyer now?
And I think we may have lost him. I don't see him up on the top.
Yeah, I see a
Yeah,
note
I think he
taker,
may
but
have
not here.
dropped.
All right, I'll send him a note.
He was afraid of your question.
He even knew it was coming. All right, well, I'll send him a note and we'll get him back in a second. But Alan, I'll direct this next question to you.
Sure.
We know that there's plenty of willing buyers out there, but to set this transaction record that we see, we needed sellers. So can you just give me an overview of where are these sellers coming from? What are they selling? And then why now?
So I'll answer the last part first. Why now? Because cap rate compression, as Aaron covered, availability of debt. I think the sector has fallen. We fell so far during COVID, kind of immediately, and then it's taken a long time to recover. There are a lot of, and this I would see routinely doing valuations through the COVID era. There were a lot of developers, a lot of owners with really solid capital stacks, deep pockets, and they were patient. And so those are the higher. And I think when you look at your averages, when we get to that, you'll see like the higher per unit price. That's reflective of prices going up, but also the type of properties that are selling. And so we're seeing a lot of those come in from the silent. A lot of, as I said, we work with a lot of institutional groups, and I think they held on through the drought, and a lot of those properties have seasoned very well, and you're seeing those come to market. So I think that more patient and a substantial owner that can wait, now is the time that they're coming in. So that's really been the difference. And I think then you'll have other, like COVID kind of took 5 years out of a lot of people's planning horizon. And I think now there's a pent up demand, not only on the buy side, but on the sell side. A lot of people have things that they needed to strategically or maybe, retire or whatever. Investor groups rotating out, and that's a lot of that got delayed. I think that's another part of what you're seeing going on in the market.
Yeah. And Kelly, where is there still a buyer's market? And maybe if you want to tell the audience what market segment you're kind of trying to work in at Arcole.
No, I think it kind of ties to some of the questions you've asked. I mean, kind of this year versus last year. I think last year was definitely more of a value add driven market. When I launched Arcole back in 2025, I think that's really where the focus was. As you've kind of moved into this year, it is much more on the core side or core plus side. I think you've seen, to Alan's point, a lot of buyers coming off, a lot of sellers coming off the sidelines, so they think they can get the value. But from my perspective, there's still a lot of value left in the properties, whether that's a little bit of lease up left, some rent, loss to lease left, or just some opportunities that maybe weren't pursued by the prior ownership. So, where we're seeing opportunity is in small value add in those core plus deals. The other thing, I think, being a smaller shop and being able to be a little bit more nimble, we're starting to dip our toe in on development and kind of prep some deals for 2027 there, which I think is something we'll probably talk about more next year. But kind of trying to get ahead of that curve a little bit.
Got it. And Ari, can you tell me, just based on your experience, how you've seen the bid-ask spread evolve so far this year? And let's talk just seniors housing for now, and maybe where it's widest still.
Yeah, that's a great question. And also, to your point, there's a big difference in skilled nursing versus senior housing. So for now, we'll focus on seniors. The good news is, like last year, I would say that bid-ask spread was pretty large and hard to overcome. And I don't know, it's been pretty consistent this year in that, like, we all see the deal flow. Deals are getting done at a record pace. So it isn't what it was. And that's good news for us and the market. If I had to identify like one area where I think it's still there, as a general rule of thumb, it would be the secondary tertiary markets. Across both A, B, and C assets, but really specifically an A asset in a B or in a secondary or tertiary market. There just isn't as many institutional investors that have been willing to go there, although Aaron earlier pointed out that, they're starting to get more comfortable. But usually the initial reaction is, we're sticking with primary markets. And where is South Dakota again? I don't know. I don't know where that is on a map. So that's been our relevant experience. Although the good news is that as the year has progressed, we've managed to get a bunch of those deals done. And then I guess a little more granular, if there was a specific area where I think there's still just this delta that is with some of our friends that built shiny new assets at a pretty large basis during COVID, and the performance is still not there. So you're not offering a buyer like a really sweet basis play, and there's no in-place performance, and those are still hard to move because like the seller's like, shit, I spent a lot of money and I don't want to walk away from all of that. Forget about upside. I don't want to lose. And the buyer's like, I don't want to buy an asset at 350 or 400K a door without any in-place NOI. So that's where I would identify a little more specifically.
I mean, 5, 6 years after the pandemic, there must be something else wrong with some of those communities as well. That
Yeah, one would suspect it's an operator that hasn't been able to focus as much, or they're strapped for cash, and there's probably some investment needed into the asset to keep it up. But or maybe it was just an overbuilt area,
yeah,
or just built too expensive, right? There were a lot of cost overruns during COVID where,
Mhm.
an asset that was supposed to cost 30 million bucks ended up costing 50, like materially more than originally anticipated. So it's hard to dig out of that hole, even in a really good market like it is today.
If I could interject, I mean, a lot of the COVID babies, just dovetailing into what Ari said, that are not working. In other words, a 60-70% occupied asset that was new, kind of state of the art, that was a COVID baby. We're seeing consumer preferences change. In other words, the baby boomer age cohort in relation to silent and greatest generation want kind of what they want. And they want oftentimes larger units. And if it's a community that has predominantly studios, as an example, that was a new build in a high-end market, that's fundamentally not what the market wants and desires at this juncture. So I would add to the outside of ingress and egress and location and operator issues and all the typical stuff. The unit mix and composition of that unit mix and unit sizes play into performance of assets today as well.
yeah. And then, much of this year, we've seen the 10-year Treasury rate just steadily increase as a result of the Iran war. But particularly in the last month or so, we've seen that really spike. But Aaron, we keep just hearing about higher and higher prices and also continually compressing cap rates. So how are borrowing rates coming up in conversation with some of these property sales, if at all, right now?
Yeah. So I've said this for years, and I have an age-old adage that there's really two arbiters of value in real estate: underlying debt costs and liquidity, in the marketplace, right? And so to address your question, Ben, head on, uniquely, I try not to be just taking two steps back, so myopic, and live in the little senior housing, swim in the senior housing pond that we all swim in, right? And confer with some of our other kind of discipline heads within the firm and really pay attention to what's going on broadly in real estate post geopolitical, kind of crisis overseas, and with a macro climate that's opaque at best now, that's caused some movement in treasuries, right? We went from a 420 to a 4, whatever, 65, 70. I don't know exactly where the 10 year is today, más o menos, in that ballpark. And for every other asset type with inferior operating fundamentals, like multifamily, as an example, that has impacted pricing almost dollar for dollar, right? Because the underlying debt costs, in other words, you have a multi-asset that should, seller wants a high four cap rate, but your debt costs are in the low to mid fives. It's bad math when your rents are flat to negative, right? In multifamily. Conversely, in the senior housing space, it is the only, including data centers, by the way, the only asset type in real estate where we've seen the weight of capital in the space surpass 40, 50 basis points of treasury rise, right? Only on a very small swath of the market that's now trading assets that are trading kind of low mid five year one, Class A primary markets, best of the best stuff? Are you getting into a negative leverage, kind of conversation at all? The difference is, and this is just the truth, is when you're growing rents in the Class A segment by between 5 and 9% heading into 2027, that you can truly be at a yield that's outsized in relation to kind of where you are, year one. And certainly, a lot of people think, given the lack of supply, that will continue to have compounded, amazing rental rate and compounded cash flow growth. And so, ordinarily, in an asset type that's operating intensive like senior housing, to have neutral leverage or even slightly negative, people would not be comfortable with. But the rental rate growth story is so compelling to folks and so real, quite frankly, that a lot of folks are willing to, for the right assets, kind of be at that level because of the perception that you're growing into a yield that's substantially larger than where you're buying it at. And I think we're the only real estate asset class where, number one, the weight of capital has not impacted materially valuations, and number two, where people are comfortable with that because the 3 or 4 years, prospect of 4.5%, 5% rental rate growth over that period of time for the right assets is very unique within real estate right now as a storyline.
Yeah, seniors housing is certainly having its moment now, and it's likely to last for years, barring anything catastrophic happening. But Kelly, I have a follow-up question to a lot of what Aaron just said. Do you see buyers, I know that they can kind of play with valuing on year one, financials, but also can look even further in the future and be reasonably assured that those resident rate increases will be healthy and that they can keep driving occupancy and do it without ballooning expenses too much. So there's a lot of positivity there, but are buyers having to significantly compromise on return expectations at all to win deals today that are seeing especially frenzied bidding environments?
Yeah, I think the answer is probably not so much, because when I look at the cap rates today, a lot of people ask, they say, well, what's the in place cap, what's the year one cap, et cetera, et cetera, and it's just very difficult because it's just a function of the rent growth expectation, and to some extent, are you stabilized in occupancy? If you're 88% and you're going to 90, if you're assuming 93 or 95% stabilized, that's a big growth driver too. So it's very difficult to peg, in my opinion. What's a T3 cap rate? What's an in-place cap rate? Market cap rate today. More so doable in the year one, but even year one in this business is very difficult because it's a big loss to lease part in the cycle, and as everybody knows, we don't turn over every year like multifamily. It's a 3 to 4 year turnover cycle. So you really have to look at a year three cap rate if you want to do an apples to apples. And the only reason I kind of go through that is that when you look at return expectations, you can have a difference of opinion on those first 3 years of rental growth, and that's the difference between a 12 and a 15 IRR, right? And so I think that's what you're seeing is a lot of times the groups that are winning have conviction, whether it's because they have intimate knowledge of the asset, whether they have a better relationship with the operator, whether they know the market really well, or just because they believe a higher level growth story. That's the group that's going to win generally in a process, because they can lean in a little more on most likely the rent growth and growth story to get to that kind of 15 IRR range. And that's not everybody, but I think that's generally how it's generally working.
And Ari, we see here in the chart that assisted living broke its annual average price per unit by a significant margin, and a lot of that was driven by a host of properties selling for $800,000 a unit, $1 million a unit, $1.5 million a unit. I'm curious, buyers are getting behind these prices. Have you heard any pushback among lenders on such high prices, the kind of pressure that puts on those assets to cover the debt?
Yeah, so the answer is yes, of course I have. Obviously, when you start getting into the $1 million range, some of the usual suspects are going to start questioning, scratching their heads. We actually have some pretty relevant experience on this, even on the development side, where folks are building to over $1 million a unit. And, we're getting some questions from both LPs and debt lenders, like, is this a price that we can all get behind? I think like everything, it depends on who the sponsor is, who the operator is, and their credit and their track record. And if they have that track record, we're going to find a lender that's going to get behind it. And frankly, like if you're a lender that's doing development deals, you're already open-minded to the idea that the tailwinds are here, the silver tsunami's here. There hasn't been a lot of development, so hey, let's get in on this. And same for acquisitions. If you're that type of lender that has that sort of deep respect for our industry and history with our industry, you'll understand that this is a really good time to be buying some really great assets in great markets because of the lack of development that's happened over the last 5, 6 years.
Mhm.
And despite how much values have risen, there's still
Correct.
good deals out there.
Correct.
No. And Alan, this average is derived from majority assisted living properties, and there's a lot that have a significant IL portion to it. And I know that, if the mid 2010s was kind of defined by a lot of ALMC buildings being built, I'd say now that has shifted to an emphasis on we like full continuum. Have you seen, is there any kind of premium put on full continuum versus just ALMC in the market today?
Well, yeah, any premium when you look at it, yeah, I kind of caveat. It ultimately starts at the performance of the property. So you could have a continuum that never breaks 90% occupancy, and I would argue you're not going to see much of a pop in terms of cap rate or valuation over just the ALMC buildings. But I think when you have the continuum that works, I would say probably 50 to 100 basis points, and that's just we as an appraiser we see that's a slice of the market that we deal with, so that may not be universal, but I do think there's an attractiveness there, and I think that model has really proven itself, especially larger land area. But if you can do apartments and then like cottages outside of that, I think that really gives you it can take longer to stabilize. And obviously the construction costs, it's a much bigger project in general. But I think there's a lot of attractiveness to that the full continuum. So I think that model's here to stay. When I built my building, AL and MC combination was still pretty much dominant. And if I look now to do another project, I would absolutely insist on having the full continuum.
If I could interject just one thing, I would say I agree with Alan wholeheartedly. As a generality, full continuum carries probably a premium, but the one caveat or exception to that, what I'd say is the highest quality, assisted living and memory care market, their assets in primary markets. We're not seeing much of a cap rate differential, especially those that are fully licensed. In other words, they have a component of independent living, but you can deliver care services inside of a independent living unit at a premium and it's fully licensed. Those type of communities, we're not seeing any cap rate differential that are fully licensed in relation to full continuum deals for the highest quality ones.
Good to know. And then as we see here, we break out the pricing for assisted living, majority assisted living by A, B, and C. Aaron, which of these kind of market segments has been the most crowded, I would say, in the last 6 to 12 months, and why?
Yeah, I mean, this is a great depiction. It's such a bifurcated market. If you look at obviously Class A versus Class C, it's a stark contrast. I would say Class A assets, primary markets built in the last 10 years, those type of assets are, again, the most active. Behind that, Class A assets and, secondary markets, as I mentioned, even getting into tertiary. People are starting to, in the Class B plus space, because of that bifurcation in, rent, therefore, price per unit. Price per unit is just a function of cash flow, right? Anyone who knows anything about this business understands it's an operating business attached to real estate, which is why if you built something for 500 a unit in the last cycle and you put a, 5.5 cap on year one and that equates to 900 a unit, the only time in my career that I can recall where people were again, I'd use the word myopically focused on price per unit, was when the sector was in a tailspin during COVID, because people know that so much of the value you can only glean, Alan. I always tease appraisers, friends like Alan and others, that you can only glean that the intangible value is 10% in appraisal, but in a well-run assisted living and memory care property, it's probably 50. It's so much value is carried in the business. And so, when I look at this in relation to the Class A deals that we've worked on, I think our Class A deals average, more like 650, 700 a unit that we've worked on, ranging to stuff in the million and a half range that we've personally been a part of. And so, I would say the most active is Class A, second most active is Class B, and then the Class C that you see here in this that's depicted is what I would perceive to be a lot of product that's quite frankly functionally obsolete, and that the baby boomer Gen 1, so when I had our chief economist at Nick run some statistics with respect to 25-year-old product or older, 3 years ago it was 42%, it's now 48%, right? And within that 48%, if you look at the last chart on this page, a lot of that is the functionally obsolete stuff. Not all of it. There's a lot of great assets that are 25 years old and well located, good, generous unit sizes, well located buildings that stand a test of time, have had the requisite amount of CapEx. So, but there's a lot of assets that, the baby boomers don't want to live in at all. And those are the assets that are moving at the lowest because they never came back. The elasticity in the rent just wasn't there to cover OpEx in a post-COVID era. And that's why you see them trading at sub 100 a door. It's not, it's just the math behind how much cash flow you can drive at those communities and rent, quite frankly. So.
And Ari, I was surprised at how much the Class B pricing changed just from 2025 to the trailing 12 months ended June 2026. So in the last 12 months, that has risen significantly. Do you think owners of Class B properties now can come to the M&A market from a position of strength from a value perspective?
Yeah, certainly more than a year ago, in my experience. And Aaron just touched on a lot of this, but the idea that some of the institutional investors are now coming to the Class B market because Class A is so crowded, is going to yield a good result for the Class B owners. And obviously, location is still going to matter and performance is still going to matter, but it's a good time to be a seller for Class B product for sure.
I imagine that's maybe alluring to a bunch of owners that last year just were not satisfied with the price that they could get in the market. But
yeah, we're seeing a lot of those owners come off the sidelines because it's now an attractive opportunity in relation to Class A, and that's an entirely different dynamic to Ari's point in relation to 2024 and 25.
Yeah,
and usually along with those Class B, it's easier to make the sales pitch that there's some value add, there's some meat on the bone left to these assets. So for a value add or opportunistic type of investor, Class A, shiny new product, primary market, that sounds like a good PE shop that puts some money to bed for 5 years and, relies on cap rate compression, right, and market growth. But if you're a value add opportunistic investor, you have to be chasing the Class B stuff. There's no choice.
Well, I just think Class B makes a lot more sense now. I mean, I think it still depends on your Class B, but the gap in going back to rents. I mean, the gap in rents from Class A rent growth is so great. It just gives Class B a much more room to run. So if you can find well run, this is an operating business. If you can find a well run Class B that all of a sudden has real NOI growth potential, because you're still comfortably 15-20% below your Class A competitors, it really opens up your NOI growth. So I'm not surprised to see it, and I think for the right Class B, I think that 230 number continues to rise this year.
I've also been trying to convince Kelly that all my Class C deals are Class B.
Yeah, well,
has he fallen for that?
Everything's a Class A.
No, he keeps on turning me down.
Well, Kelly, I'm curious, in your eyes, is it even possible to turn a Class B into a Class A? I know with enough investment, it's possible, but just with room configurations, is it ever feasible to do that?
Oh, first of all, Ben, I don't think no. So I think there are some certain areas, but there's a lot of buildings that you can never turn B into A, right? And a 325 square foot AL unit can never be an A property, period. You know, a 450 square foot IL unit can never be an A property, period. And
Mhm.
you know, and I'm not a fan of the let's knock the units down and collapse the walls, and you know, I mean, those never look Class A when you're done unless you spend like, you know, 35 grand a unit. So yeah, can you? Yes. Are there buildings with bones? Yes. Are there buildings with excess acreage and buildable square feet? Yes. And I think you know, high ceilings, wide hallways, or you know, good. Yes. And I think you'll see more of that. You know, that's obviously riskier, and I think that's going to have to price at a premium. But you'll definitely see people going in. Um, but I think it's tough. I mean, this, you know, everything that was built, not everything, majority of that was built prior to 2011 was built this in a completely different, you know, um, floor plan than you want to see today. And I think, you know, more so than multi and a lot of their businesses, you know, the new vintage assets are kind of just built differently that's why they're Class A, and it's hard to replicate that. You know, despite how much money you spend on a reno.
Yeah. So if Ari tells you that it's an easy switch from B to A, you may just have to visit the property and scratch beneath the surface.
That's, you know, Ari says throw a couple $1 million in it, put some new carpet down, you got an A property, and you know, sometimes he's right, but
I can't believe you would accuse me of that. I've never said that. I've just said that the C could turn into a B. I agree with you. The B is really hard to get into an A, but certainly a C to a B, we got this.
I agree with that. A C to a B is a C to the difference in C's and B's are a lot of times money, love, and operations, and I think those are more doable.
Hey
Thank you, Ari, for that
guys, I think
distinction.
this is like a good encapsulation of the seller and the borrower mentality. The C's to the B's. This is what we hear all day long. When we look at properties, and is that value proposition? But I agree. The B to an A, tough, really tough, and the C to a B, I think that's a lot more manageable.
Yeah. Well, let's quickly touch on cap rates. Again, these are based on trailing financials. Aaron, I'm curious what you're seeing in the Class A side. What do you think is the floor for cap rates right now, both on a trailing basis and maybe on a year one basis, generally speaking?
Yeah, I mean, trailing is it trailing three, trailing six, trailing, I think a better apples to apples comparison, whether it's 3 years out to Kelly's point or 1 year out, tax adjusted and occupancy adjusted. The way we look at it, in most cases is, occupancy adjusting down to, 95, maybe 96 in the tightest markets that are very, very full, and then tax adjusted as well, right? For non-enterprise, sales. And so, in that segment of the market, it's funny when I look at this chart and I see average cap rate at 7.7, it's such a bifurcated. I mean, we haven't worked on a Class B deal that's traded, anywhere outside of the, high sixes, year one in, a long time. So I kind of stare at this, and scratch my head a little bit. We're seeing the best of the best year one tax and occupancy adjusted trading in the low mid fives today for really high quality assets. Certainly in the coastal markets, East and West Coast, and then even in high quality growth markets, in Texas and in the Southeast. Same thing for, highest quality. Continuity of operations on assets with lack of business interruption risk. That's a big thing, in paying the lowest cap rates as well. And if there's alignment of interest, you have that fact pattern, and we're seeing as low as kind of low mid five, type stuff on year one occupancy and tax adjusted, and a lot of stuff trading in between there and call it kind of mid sixes, year one, depending whether it's Class A, Class B, primary, secondary market, which is, a stark contrast from this chart, but that's, by and large our book of business.
Yeah,
Yeah.
this chart is actually like kind of interesting to me too. I'm looking at it and also scratching my head. Like, do you have a Medicaid waiver in this chart? Because
Yeah.
like that seems like a really high cap rate to Aaron's point.
Hmm.
Yeah, I
Well,
mean that the
it's
stuff we're seeing trade in that cap rate range is the older, kind of, smaller, unit count and size properties, or with a component of, Medicaid waiver or equivalent types. Some of the states, whether it be Massachusetts or Illinois and so forth, have state programs that are effectively spend down before Medicaid kicks in. That type of unit composition obviously carries it with a different renter profile, a different cap rate, but we're not seeing stuff in the Class A or Class B at this range. So I'm kind of scratching my head a little bit.
Yeah. No, I would say that this is encompassing of all Class A, Class B, Class C, and it's not unit or like just deal size weighted at all. So a lot of those kind of larger
Mm.
Class A deals, portfolio stuff that we've been seeing trade at those very low cap rates, it in this average, it has the same weight as a smaller Class C deal at a nine and
Got
a
it.
half percent cap rate.
Got it. Okay. That that
So
make that makes sense.
yeah, in our full acquisition report, we kind of break it all out further to make those distinctions. But
I think a weighted average maybe been a good depiction next go around because I think that's more reflective of the market, quite frankly.
yeah.
There's also a delta, Ben. You worked in all this based on trailing, and I think Aaron mentioned using like the year one. So from an evaluation standpoint, we're schooled that we're only to use the buyer's forecast of net income to develop a cap rate in a transaction. And so to your point earlier, there's always a lot of dialogue about that. So
Mhm.
and that can be, like a 50 basis point delta in your cap rate as well. And so, that's just how we look at it. So we would probably have a lower average just by virtue of that.
Yeah, it's we're kind of in a way, trapped is a tough word, but all of our historical data is based on the trailing stuff. So
Yeah.
making the
Mm.
switch to the forward looking is a little
It's
tricky.
it's tough, and we've always maintained ours based on forward, but I think that's harder to really pin down
Yeah.
because you're trying to get a buyer to give you their estimate, and that's kind of part of their secret sauce. And so, we'll get
Hmm.
the estimate as an appraiser. This is a transaction, here's the estimate, but it could be one of three estimates that they've actually, which is the one that they feel the most confident about. I think that
Hmm.
you look at our sector, and when you're doing traditional real estate, flat real estate, which real estate without a business component. I think it's a lot easier to do that. You're looking at in-place rents. You're not looking at the volatility that a business operation has. So when you look at our real estate, and to everybody's point, that the volatility of that operational component is where the value is at, but that's also where the uncertainty is at.
Yeah. Well, what you just described is kind of why we had never relied on forward looking because we were never sure exactly what numbers we were looking at and how realistic they were.
Yeah,
But
it's really tough. We try to tease out. I see like we look at different approaches to different the way people do things, and that's really the most accurate way to do it, but it's also the most difficult. So we have, fortunately, we've got a lot of really great relationships in the industry, and we'll get those. And sometimes, even for like pension funds or whatever, we're not allowed to use the data from any transactions that they're a part of. And it's kind of like it's very frustrating because like, okay, we know the answer. We've got all the information we need on a Class A high dollar per unit sale. We can't use it. But it's the nature of the business.
Well, I tell you, I think that just shows the strength of the market because typically, what Alan's describing, when the appraisals are lagging the values, it hurts your financing, and that then becomes, almost like becomes circular where it starts kind of putting a brake a little bit on values.
Mhm.
And I haven't really seen that, even though, we're most deals are in negative leverage territory, and I think appraisers are, struggling to look at the values that are being paid when you're looking at a trailing 12, which historically is what guys like Allen have done. But it hasn't really slowed things down. I think that's the conviction people have in the growth story here, and they're working through it. And but I think it's also the lender side, the lender community is also getting kind of leaning in as well to make it work.
I will tell you the hardest part of a market cycle is that first 6 months when you're looking for data, and maybe 9 months, 6 to 9 months, and the chatter will be everything's a five cap, a six cap, whatever, the particular environment. And as appraisers, we're hearing that, but we're not seeing it yet. And, the deals where people so we're past that stage. And I think now what you're seeing is a lot of those transactions, even if they're private, there's enough information out there, even if it's nothing we can disclose. But as an appraiser, I will take that information into account. And, maybe I can't necessarily say here's 10 sales. Maybe I could say here's five, but I'm hanging my hat on, a cap rate of 5.5, 6, 6.5 as appropriate based upon everything else we're talking about with the people in the industry.
Hmm. I think we just in the interest of time may have to motor through independent living. But does anyone have anything to say on that sector and
Yeah, I mean,
how values are changing?
it's not been a sector that's been the most popular. In other words, there's been more full continuum or ALMC. But however, when you built in the last cycle as just freestand as opposed to freestanding independent living, but I tell you what, for the freestanding independent living, forget about PPU for a second. It's just again a function of RevPOR, and is highly desirable. And with respect to what we've seen. And you get, interestingly now, a subset of institutional investors that are only inherently comfortable investing. It's a smaller subset, but a subset nonetheless in lower acuity segments, i.e., active adult and independent living. You start to see these kind of crossover buyers on the institutional side, some of the DSTs that prefer independent living for a variety of reasons in their investment structures, and folks that show up on these processes that aren't necessarily showing up on a ALMC transaction. And so I would say the yields, not necessarily the PPUs, because that's a function again of rent, and but are quite attractive right now for freestanding independent living. We've worked on a couple of freestanding independent living, properties, a few I can think of on the East Coast that were, highly attractive with respect to yields and as lower or lower than anything we've seen in the full continuum.
Yeah, I don't
Just
know.
given
In the way you framed it, I don't know if that was a negative, but we've seen, we have independent living only in our portfolio. It performs very strong.
Mhm.
There's clearly a value prop in, the activities and the dining versus an active adult. I know that was a big discussion point, what, 22, 21, 22, even 23 of is active adult going to eat us independent living? I think the
Mm.
verdict's pretty clear. It did not. And in fact, the gap spread dramatically. Rent growth and independent living has been extremely strong. And active adults kind of honestly tracked multifamily in a lot of respects. So, no, we've seen great growth independent. I think anytime you can offer the additional continuum that's except to a couple, there are some investors that really like not having any of the care component, but I think people prefer, but I don't think there's not a negative in the market. There's not a discount in the market. And for some buyers, I think it's a bit of a premium.
I would just add
Mhm.
we've had a really good run on the independent living side, and I agree with Aaron and Kelly. There's been some great crossover from the multifamily side of the world where they just can't get comfortable with the care component. They don't want to hear about acuity. One interesting thing that I've had trouble with is independent living just financing standalone independent living. What we find is a lot of our healthcare lenders don't know what to do with it, and it kind of falls in this gray area. So, where some of the usual suspects who I would think would jump on an IL only deal, they're like, I don't know, that doesn't feel like healthcare. We're shooting it over to our friends in multifamily, and our multifamily friends are like, still sounds like healthcare to me. I don't want to touch it. So it sometimes has fallen into this weird space, but we have had a fair amount of success getting it done, and continue to see some of our friends really grow in that space.
Yeah, I would say the for the agencies, it's a 130 DSCR versus 140, and that's very helpful. We've even seen for a couple of really high quality independent living deals drop down to 125 for acquisitions with a lot of equity in front, which is a multifamily step for independent living, given the better margins and lack of again operating complexity. So I will say in an agency context, I agree with Ari on the bank side. Sometimes it's a who's on first with a chunk of the lending market that only wants some level of acuity to domicile it categorically within the healthcare senior living vertical of their business units. But on the agency side, we've seen a lot of aggressivity within this segment.
All right. Well, Ari, I want to touch on skilled nursing a little bit. As we can see here, there's we have a national average. That's not too useful on the skilled nursing side. It does show a trend and just how facilities are getting valued overall. But we know that what's really important is the state by state valuation differences, and then locality by locality too, just based on their reimbursement rates and labor costs. So, do you mind just giving a it's a very loaded question, but a quick overview of whether you've seen this kind of pricing rise in the market as well, maybe how it differs from what you've seen, and then just why are values rising so quickly in the space?
Yeah, I love talking about SNF in a predominantly AL environment where I could see if the proverbial audience that I was looking out at, I could see their eyes roll
To
back.
our audience, we will be going back to seniors housing
All right,
after
all right,
this.
okay.
Thank
So
you, Ari.
I'll keep it short, but I mean this chart again is puzzling to me because I would say we are seeing dramatic price differences than we saw from even a year or two ago. Obviously,
Mhm.
look, it's very state dependent, like you said. States like Maryland that have had strong reimbursement and strong labor markets for a long time, they've always been high per bed, right? And like that hasn't really changed dramatically. But then there are a bunch of other states that hell, if I could sell a portfolio for 65K a bed, I was happy. And today they're going for like 150K a bed, and maybe I'm not going to sell because I don't really know what to do with the money.
Mhm.
And so we are seeing really, really hot skilled nursing market. Um, and I think really the fundamental issue there is that the family offices have come in and gobbled up so much of market share. There's only 15,000 nursing homes in the country. No new ones are, essentially zero are being built. And so like a lot of the family offices just want to their exit, unlike in the senior housing world, they don't have 5-year fund life, right? Their exit is essentially to put it to bed with HUD. And
Mhm.
once they get it to HUD, they're clipping coupons. Hopefully they're providing a high level of care and they're letting their operator do their thing. So um, there isn't really a great reason for them to be selling. So if they are selling, you better be delivering a really, really big number, right? And so that's really, I think, been the driver, obviously, along with the idea that rates have stabilized in a lot of these states. Um, the government has done away with staffing mandates, and so
Mhm.
that has allowed other operators that were hesitant to enter a certain state, like New York, as an example, get more comfortable. And I think just generally the M&A, supply and demand just isn't there. There isn't enough
Yep.
supply to meet up with demand.
Mhm.
So how are buyers maybe adapting to that lack of supply of facilities available for sale?
I'm seeing a lot of the operators who historically would never take on a triple net lease deal
Hmm.
as pure operators because they really wanted a way to the real estate. I'm seeing a lot of them say yes. Hey, we'll triple net lease. Just throw us a purchase option, maybe in 5 years at some egregious number per bed, and we'll hope that we'll get there.
Hmm.
Um, and we'll hope that values continue to rise. But again, like I live in both worlds of senior housing and skilled nursing, and since my career, 2011, we've seen senior housing kind of like go way up, and then COVID brought it to a screeching, halt,
Hmm.
and life didn't look too great for a while. Skilled nursing, it's just been that way. So, it's kind of hard to make the argument, hey, sell it today because you should be nervous about tomorrow. I'm not so nervous about tomorrow. I got this.
Mhm.
Yeah. Yeah, really with those long-term blinders on almost of it could be choppy just with stroke of the pen risk and maybe PE issues in certain states, but like long-term supply and demand just of the beds available is pretty attractive.
Mhm.
Correct.
And the government has shown that it generally will be there to support the industry because it
I
is a
think
low-cost
that's
provider of
Yeah,
care.
yeah, Ben, that's what's changed, I think, in at least from looking at the financials that we're given and looking at the per bed values that flow from that. And it's predictability and stability and durability of the income stream, right? And so that's really the formulation of you extract risk from that, risk premium or whatever. And I think we're in a time now where there of the time I've been doing this, I should correct my CV. It's actually 40 years, but the time that I've been doing it, I think I've when COVID hit, there was an expectation that reimbursements were going to go back to pre-COVID levels. And largely that didn't happen. And I've been very, there's 50 states, there's 50 different markets for skilled in the country. But, that to me was, and I've watched it because I always see, the payers trying to claw back wherever they can. And I just didn't see that. So to me, it's been very heartening to see finally, I think the SNF side of the business get a little more respect. And I think those, there's more cushion in there. The margins are better and you're seeing it translate. And I think that the sense is that that is probably going to stay. And so you're seeing that translate into valuations.
Yeah. Well, I'm just going to move into the last couple of seniors housing questions I have. We got about 5 minutes left. We may have to go over by a few minutes. But just quickly, Ari, if you own a class kind of A minus B plus property today that's currently underperforming in a market of competitors with strong occupancies, so there's a reasonable case that you could turn around, maybe with a new operator. Do you replace the operator today and sell in a year, or based on where values are now, do you sell today? What would you do?
That's a really great question. And as usual, I'm a broker, so I'm gonna, try to think about my answer and not give you a straight answer. I'm kidding. I think it will depend on, first of all, do you have any money to invest into the asset? Because there's probably some need for capital. If I had to guess, given your example, if the market is strong and your asset is struggling, so either it needs capital or it needs a new operator or it needs both. And so if you have capital and you also have an operator that you really trust, then I say hold for a year, let the new operator come in, and if that operator has the track record to turn this thing around, let's give it a year, right? But on the flip side, like if you don't have a ton of conviction and you're not sure, sell it because this is as good of a market as any to sell. And you can probably get pretty damn close to where you're going to get in a year from now if you just sell it today and leave a little bit of the meat on the bone for somebody else.
Yeah. Yeah. I mean, could lead to more of a bidding frenzy if people see that potential added value.
Not could, I'm pretty sure it will. So yeah.
And maybe quickly, Aaron, do you see more multifamily investors coming over to seniors, either in M&A or in development in the next couple of years? And then what do you think they'll target, if yes?
Yeah, we do again within the institutional segment. A lot of the folks that have been either investors in the sector but are now domiciling investments in better cost of capital, asset agnostic, best idea funds with a low cost of capital, and then folks just categorically that were not in the market at all that want senior housing exposure. We are seeing a ton of inflow of those type of investors. With respect to, it's a really tough question with respect to acquisitions in relation to development now. A lot of folks, development is necessitated. I mean, if you look at statistically the market now, according to our NIC data, there's whatever 15,500 units on a rolling basis, and in 26 we need 115,500 roughly to satiate the demand vis-a-vis the baby boomers to keep occupancy at equilibrium at 90%. So that is a gaping hole with respect to development. But a lot of investors, despite that, are looking at the market going, it's really expensive to build right now, and we're going to enjoy unprecedented compounded cash flow growth and rent growth for the next 3 or 4 years. And if we develop and get into deals now, we're not going to get that. I think we're starting to see development now in a significant way for the first time in a long time. What percentage of the institutional investors are actually considering it? Maybe 20%, 25%. And that was close to none 2 years ago, 3 years ago, in relation to acquisitions so we are starting to see development. We do think development is necessitated in markets that support very high rents, where you can justify the basis in today's day and age.
Yep.
And so I don't know if that addresses your question, but we are
Well, it could
serious.
be some of the multifamily guys doing some of that
Yeah, I
development.
think when you say multifamily, I think there was a lot of mistakes made in the last cycle, so far as development and kind of folks partnering with the wrong operators or trying to self-operate that were multi or coming from other spaces. I think there's a lot of lessons learned, and so I think on the institutional investment side, we're seeing more folks get into it as opposed to just multifamily developers We are seeing certain multifamily developers starting verticals and what have you, but you have to be a lot more thoughtful, in particular on the operating side of the business, because there was a lot of mistakes made for what I would characterize as transient developers coming from other spaces that were moonlighting in the senior housing space in the last
Hmm.
cycle. And I think a lot of people are cognizant of that.
Yeah. Oh, yeah. Some of the phone calls we were getting definitely showed some inexperience and totally unaware of the operating intensivity of of the sector.
Mhm.
But I want to end on a sort of rapid fire question, maybe no more than 30 seconds each, even though it is a loaded question. But knowing about all the various pricing trends, the different bidding environments, the different headwinds and tailwinds for each property type, market type, I just want to ask each of you, what investment would you make today and why? Aaron, do you want to start us off?
Man, it's like picking between your children, you know. It's kind of a challenging one in today's day and age. I mean, look, I think like I said, and I don't mean to give you a lack of a direct response, but I think I really do believe this is not just, broker speak to Ari's point. I really do believe that we're going to have, for all these folks that are underwriting core and core plus deals at 12% levered returns with low leverage, a lot of these guys are going to look up and say, gosh, I got a 14 or a 15 because I got 5.5% rental rate growth in the first 3 or 4 years, or whatever the case may be. And I really believe that that's factual because at the end of the day, there's not going to be enough product given the gestation period of development that's coming into the market that's statistically relevant to impact markets across the country. We're 4 to 5 years at minimum away from that. So I think the outsized return profile for the right assets can get really good rental rate growth is there. I also think that for a subset of the vertically integrated developer owner operators or operators partnered with developers that can get capital today, we've capitalized a couple of very high profile developments, debt and equity recently. They're thinking about it as a contrarian approach. In other words, let's get into the development cycle for these precious sites, some of which we were pursuing pre-COVID and are now pursuing again before it's a herd mentality. In other words, in 18 or 24 months, mark my words, everybody's going to be talking about development. How do we get into development? There's no more product to satiate our acquisition needs, blah, 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 right? And those that are thinking about that in a constructive way, that are thoughtful about what they're building and why they're building it today, I think are to be very well positioned. So we're starting to see that as well. Those are the two kind of segments of the market I think I see as really interesting. The last thing I would say, I don't want to be too long-winded, but because the rental rate growth has been better than multifamily, I would say, in active adult for sure, somewhere in between multifamily and active adult. That segment of the market, I think, is going to pick up as well in relation to the muted transactional kind of volume. And I do think we're seeing more stickiness in the rents in that segment of the market. And I think it's kind of been overlooked to a certain degree in relation to senior living. But I do believe that there's very little product that's coming to that market as well. And
Yep.
10, 15 years ago, nobody knew what it is, and everybody now, an educated consumer, let alone institutional investor, knows what it is. So that's an interesting and, quite frankly, overlooked in relation to senior living segment of the market. So sorry to be long-winded.
You're spreading your love. I think that's a good way of approaching it because there's a lot of good options. Kelly, what about you?
Yeah. Yeah. Well, look, I think Aaron covered a lot of really interesting areas, but for me, really being operator first on the buy side, what I still find very exciting are nice properties, whether they have, a little bit of room left or whether they're performing pretty well, but that's not just not operating as well as they could, really bringing in that great operator. Because at the end of the day, this is an operating business. We all know that. And, you don't make money if you don't manage well. And so I still think there's a lot of that opportunity out there. And that's an area we're focused on pretty heavily right now.
Yeah. Ari?
Uh, I won't have as nearly a prolific answer as Aaron or Kelly, but it's B assets in strong secondary markets with some meat on the bone. For me, that would get me excited all day. No offense to all my friends in Class A and C, but that's what I would target. And then shout out to my skilled nursing friends on that side of the world. I would say any market where I have a strong regional operator that has credit and I can triple net lease it to him, I'm in.
Sounds good. Alan, take us home.
Yeah, really quickly because everybody covered such good points. But I'm with Ari. I like a secondary market. I would do new like Class A minus development, construction in a secondary market that's growing and that has good, 10-year population, senior population numbers. I think what's going to happen is the say the 900 to a million and a half per unit is going to be so enticing that I think that Class A or the A market and the Class A building in the A market is going to get really, really hammered. I think that this slightly easier, lower barriers to entry in a secondary market, as long as it's a good one. So that would be that would be, and of course, you can have competition as well, but that would be where I'd go.
Yeah. All right. Well, we just went a bit over, but not too much. Did have to
Mhm.
skip some questions, but you guys, that was a fantastic conversation. Kelly, Aaron, Alan, Ari, thank you so much for the time. Thank you so much for the preparation for today also. And I think the audience certainly got some clarity in what is going on in the market today. And it's still going to be fast moving. So we'll have to probably reconvene in another 3 to 6 months just and have maybe a very different conversation.
Mhm.
But I appreciate the time from everyone. I appreciate the sponsorship from Health Trust as well. And to our audience, once you close out, there will be a survey that'll pop up, and all of your answers are greatly appreciated. And we use them to improve our future webinars. So thank you all for attending. Panelists, thank you so much for your time. And that is it.
Thank you, Ben.
Have,
Thanks,
have a
Ben.
Thanks,
great
That's
day.
everybody.
great.
You guys.
Enjoyed it.